What is a cap rate in real estate? In a world of digitalization, real estate is still arguably your best bet if you are entering the realm of investment. While making a good foundation, real estate has the potential to generate larger and more frequent returns as compared to stocks, cryptocurrencies, or bonds. However, to make sure you're choosing the most sensible and educated course of action, it's crucial to first educate yourself thoroughly about it. And if we're talking about real estate, then there is no better way to start than capitalization rate. Watch the video till the end as we delve deeply into what is a cap rate. Also, if you want to learn more about passively investing in multifamily real estate, don't forget to check us out at greatventurecapital.com. In real estate, the capitalization rate, commonly known as cap rate, is used to determine an investor's prospective return in the investment property. Computed based on the predicted net operating income, the cap rate can be useful for comparing the relative values of comparable real estate investments in the market quickly. However, it shouldn't be used as the only metric to gauge the strength of an investment, because it ignores factors like leverage, the time value of money, the potential future cash flows from property improvements, etc. Being the most commonly used metric to evaluate real estate investments for their profitability and return potential, the cap rate only shows a property's yield over a 1-year time horizon, presuming the property was bought outright with cash and not with a loan. The capitalization rate represents the intrinsic, unleveraged, and natural rate of return on the asset. The cap rate is calculated by dividing the property's net operating income by its current market value. The predicted annual income from the property, such as rent, is known as net operating income, which is calculated by subtracting all management costs. These costs include the price paid for the property's ongoing maintenance, as well as the property taxes, whereas the asset's current market value is the current value determined by the ongoing rates in the market. Now, let's consider two properties that, aside from location, are identical in all other respects. One is in an upscale section of the city center, while the other is in a rougher area. Considering all other factors equal, the first property will produce a higher rental income than the second, but those gains will be somewhat offset by the higher maintenance costs. Due to its much higher market value than the first property, the property in the city center will have a cap rate that is relatively lower. On the other side, the second property with a higher cap rate indicates a higher level of risk because it suggests lower than average returns. In simple words, what you hope to gain from an investment and how much risk you are ready to take on are the two factors that determine a decent cap rate. A higher cap rate suggests greater risk, while a lower cap rate suggests reduced risk. Additionally, cap rates typically have an inverse connection with the value of the property. A higher cap rate means the property is less expensive, and a lower cap rate means the property is more expensive. Most people take the cap rate as a risk indicator. All in all, cap rate is a very common tool used by real estate investors to calculate the prospective return or profitability of an investment. That is it for today's video. We hope you enjoyed the content of the video. If you did, show us some love and hit that like button. And don't forget to subscribe to our channel so that you never miss out on any of the amazing videos we have in store for you. And don't forget, if you want to learn about how you can passively invest multifamily real estate, reach out to us at greatventurecapital.com.